Whenever we speak of the biggest economic crises of the 21st century, we cannot help but think of the great financial crisis of 2008. Visuals of the world stock markets trading in red, visuals of stockbrokers looking helplessly at the collapsing stocks, and reports of huge job losses are the scenes that characterized the economic chaos that followed. The reason? The collapse of the U.S. housing sector. A market that was once described as booming and even safe for investment was brought down to its knees. Hugely inflated prices and a lending process that failed to slow down eventually led to a situation wherein the prices deflated in a short span of time. 15 years later, a similar onset is being detected by economic seismographs. Will this lead to another economic quake that will send shockwaves throughout the globe? Or are our systems more resilient? Let's explore this piece by piece, starting with the current economic situation in the U.S. Chapter 1. Inflation that is refusing to cool down. The current year of 2023 and the whole of 2022 have been distinguished by high inflation in the U.S. The economy that is feeling the brunt of the Russian invasion of Ukraine, the after effects of the pandemic, and a renewed challenge to its dollar dominance has been suffering from inflation figures that exceed the desired 2% mark. The U.S. Federal Reserve has been raising interest rates to ensure that it falls below or close to the desired figure, but with little success. The monetary policy is the premier tool used to influence the price level in an economy. In the U.S., the Federal Reserve has raised the interest rate 11 times since 2022, the most in history. This has kept the cost of credit high, and the banks have been losing the ability to expand their credit outreach. Doesn't this translate to high mortgage rates? Absolutely. The mortgage rates have been high for quite some time in the U.S. The current 30-year Federal Housing Administration mortgage rate has remained astronomically high at 7.37%. To put this in a wider context, we have not seen such a high mortgage rate in 23 years. Let's look into the intricate details of how such a high mortgage rate might have catastrophic ramifications for the housing sector. We're always creating new content, so be sure to hit like and subscribe to our channel so you don't miss a thing. Now, less than 1% of viewers have subscribed, so it would help grow our community. Chapter 2. The Housing Market Variables and the Impending Doom. There are many variables in the housing market that we can take a look at in this chapter. Let's explore them one by one, explaining their consequences. As mentioned earlier, the 30-year FHA mortgage rate has been the highest in 23 years. It's put off people from buying new homes and has also prompted current house owners to stay put and not list their properties for sale. And since it's a structure that has the highest market share, it's bound to affect a big chunk of potential homeowners. Will this not affect the inventory in the sector? You're right. The current situation entails that the number of houses that are up for sale is very low. If we look at this chart, the housing inventory is the lowest it has been, even lower than the period preceding the 2008 crisis. If history is anything to go by, high housing prices and a low inventory contributed to the perception that real estate is a safe investment. However, when the bubble burst and the housing prices crashed, the market was flooded with homes for sale, characterized by people wanting to get rid of and recoup their losses as much as possible. This drives us to our next variable. You might be wondering exactly how high the prices are in the market. The answer would surprise you. According to recent reports, the median house cost stands at $406,700. It's been the highest in 28 years. The data from the 2008 crisis shows us that the same metric stood at $200,000. If we adjust for inflation, the variables become eerily similar. A metric usually used by realtors to gauge the affordability in the housing sector has also skyrocketed. Even if it's not a hard and fast rule, it's stated that the household median sale price should remain 2.6 times the household median income. If you were earning $100,000, it would be assumed that you can afford a $260,000 home. What do the numbers say on the ground? According to reports, the household median income was pegged at $71,538. I know my math is a little weak, but I know for sure that $71,538 times 2.6 does not equal $406,700. Affordability of a house, therefore, can only be restricted, at least currently, to the ultra-rich. You might be thinking, isn't that an average? Some states might be better off than others. You might be right, but this report by The Guardian tells us otherwise. It lists down the various metropolitan areas in the US and reports that these areas are way off the 2.6 times metric, confirming our fears. These variables combined paint a pretty gloomy picture of the housing market. Although some companies are attracting consumers with innovative interest rate structures. Let's take a closer look at some of them. Chapter 3. Is innovation breeding risky loans? As we saw in the previous chapter, many variables are currently plaguing the housing sector. With the homes becoming expensive and the mortgage rates reaching record highs, it's no wonder that there are fewer mortgage applications. Reports suggest that mortgage applications reached a record low this year. And can you blame them? The majority of the income groups are being excluded from the housing market. That makes us think, wouldn't that affect the profitability of the organizations providing home loans? Absolutely. If there's something we know, tough times breed innovation. In such a scenario, a structure put forth by the company Zillow has caught our eye. As reported by CNN, the revenue of Zillow was down by 17%, or $24 million in their mortgage business. So what have they come out with? They're terming it as a 1% down payment loan program. The buyer would put down only 1% as a down payment, and Zillow would put down 2%, aggregating it to 3%, which is the most commonly touted requirement. This would pull down the costs required to purchase a home and still fulfill people's dream of owning a house of their own. Even though there are some conditionalities on who's eligible and the program is only restricted to Arizona, caution is still advised. A greening of these types of loan structures could potentially give rise to moral hazard. Even though these may seem attractive initially, the jury is still out on how sustainable they are. If this was not enough, Bank of America has upped the loan structure even further. It's offering zero down payment, zero closing cost mortgages for minority communities. In other words, it provides loans to eligible buyers that eliminate the necessity for a down payment, closing expenses, or private mortgage insurance, PMI. PMI is an additional expense typically required for buyers who contribute less than 20% of the home's purchasing price up front. As the revenue keeps plummeting and the lending entities continue to innovate, it can easily give rise to loan defaults. A throwback to the 2008 crisis, when buyers defaulted on their payments and lenders had to foreclose homes, gives us a valuable lesson that such programs, even with their conditionalities, can be potentially dangerous. So what's the way forward? Are we witnessing the calm before the storm? Is a déjà vu of the 2008 crisis in the cards? Let's explore how this can play out in our last chapter. Chapter 4. Imminent Economic Collapse and the Way Forward. The variables that we have examined in our previous chapters do suggest a sense of an imminent housing market collapse. In economics, the interplay of variables is quite complex, and there is no hard and fast rule that doom is bound to happen. Experts suggest that reports of a crash similar to the Great Financial Crisis of 2008 may be exaggerated. Why? The period of granting of loans that preceded the 2008 crisis was called liar loans, specifying a practice wherein the lenders did not do a detailed background check on the borrowers. However, the picture has now changed. The conditionalities are stricter, and the lenders are wary of lending to just anybody. But what about the variables that we studied earlier? High market prices, high mortgages, and low inventory. Are these variables that present a dark future? Certainly. However, experts suggest that the construction activity is not even comparable to the pre-2008 levels. The current trend in prices is a result of the mismatch in demand and supply. As construction picks up, the prices may cool, and the inventory may get hiked up. Home foreclosures, a sign of home loans getting defunct, have not been high either. This was characteristic of the period succeeding the 2008 crisis. They were not high even during the pandemic period. Even though they've increased in recent times, a sudden increase in foreclosures causing a housing crash seems unlikely. All in all, the future will be determined by a complex interaction of the variables that we have studied. Economic theories are well and good, but in practice, the way it plays out in real life is determined by factors that cannot be quantified. As the reports of the U.S. economy slipping into recession gain traction, fears are bound to grow. At the same time, cautiousness will grow too. In the last 2 to 2.5 years of the pandemic period, international conflicts and financial crises have taught us valuable lessons. It's our role to ensure that history does not repeat itself. If you enjoyed our deep dive into the housing sector, give us a like and subscribe to our channel. While you're at it, why don't you press the bell icon? It will notify you whenever we upload. Thanks and goodbye.